Imagine this. You've worked hard, you saved some money, and now you want to invest. But suddenly you face a jungle of choices. Index funds, mutual funds, hedge funds, ETFs. Everyone is talking about them, but few can explain clearly how they differ, how they work, and most importantly, which one makes sense for you. Hello there, my name is Leandro Guerra and I'm the founder of the Outspoken market. And in this lesson, I'm going to break it all down in plain English. By the end of this lesson, you will understand not just what each fund is, but the logic behind them, so you can see through the marketing noise and start thinking like a professional investor. Let's start with the index funds. An index fund, it's basically an investment vehicle that tries to mirror the performance of a market index, like the S&P 500 in the US or the FTSE 100 in the UK. Instead of trying to pick winners or losers, the fund simply buys all the stocks in the index in the same proportion. Why does it matter? Because it takes away the human judgment, research costs, and the mistakes that come with active management. Index funds are then low cost, passive, and long-term focused. Think about it. Instead of betting whether Apple or Tesla will outperform the market this year, you are betting on the entire US stock market. Over the decades, history shows that this simple strategy outperforms most actively managed funds after the fees. So there are some pros. They have very low cost, they are simple, and they are diversified. The cons: you will never beat the market. You will only match it. Okay? Second point, mutual funds. Let's move to them. Mutual funds, they pull money from many investors, just like an index fund will do, but they are usually actively managed. That means a fund manager or a team of managers is constantly deciding what to buy and sell, trying to beat the market. Mutual funds are one of the oldest and most traditional ways of investing. If you ever opened a retirement account through your employer, for example, chances are it was filled with mutual funds. The benefit in this case is, in theory, the professional management and the access to a diversified portfolio without the needing to pick individual stocks. But here's the catch. Mutual funds often come with higher fees, somebody has to pay it, and statistically most of them don't outperform the market after the costs. There are some pros for sure: access to professional management, convenience, wide choice of strategy, and the cons are the fees, potential for underperformance as well. So need to balance it. Now, the third point, the hedge funds. Let's get then a bit more exclusive. The word hedge, it's a bit misleading in this case. Originally, hedge funds were created to protect or hedge against downturns by balancing long positions, that are in the case that you are betting that prices will go up, or short positions betting prices go down. But today, the hedge funds are much broader than that. They can invest in stocks, bonds, derivatives, currencies, real estate, you name it. They are known for being aggressive, secretive, and often very innovative. Some use leverage to amplify the returns, others use quantitative models, arbitrage, or global macro strategy. But here's the key. The hedge funds are usually limited to wealth individuals and institutions. They charge the famous 2 and 20 fee structure, like a 2% annual management fee plus a 20% of profits above the benchmark. The pros: sophisticated strategies, potential for very high returns, and the cons are the high fees, high risk, low transparency, and restricted access in this case. In short, the hedge funds are not for everyone, and most people will never invest in one directly, but they are important and they influence markets globally. Now, the fourth one, my favorite, are the ETFs, exchange traded funds. Let's talk about them. An ETF looks similar to a mutual fund or an index fund, so it pools money from many investors and invests in a basket of assets. The key difference is in the structure. The ETFs, as the name suggests, they trade in an exchange like on a stock. You can buy or sell them during the day at market prices, just like you would do with Apple or Google shares. This gives them, the ETFs, flexibility and transparency. You can see their price real time, daily, whatever, and you can use them for strategies like hedging, and they usually come with very low fees. Many ETFs are passive, so they just track an index like the S&P 500, but others are thematic. They focus on things like clean energy, AI companies, or even Bitcoin futures. So you have pros like the low cost, high liquidity, and tax efficiency, as they are also easy to trade. The cons, too many choices. Some exotic ETFs carry very hidden and high risks. We need to compare them all very quickly. Let's make then a comparison. Just a recap. Index funds, passive, long-term, low cost. Mutual funds, actively managed, higher fees, widespread in retirement accounts. Hedge funds, exclusive, high risk, high reward, not accessible to most investors. ETFs, flexible, transparent, low cost, and tradable like stocks. Now, when you hear the word fund, remember, they may sound similar, but the structure, fees, and risk can be and will be very, very different from each other. So here's the takeaway. The funds, in this case, they are tools. What matters is how you use them. So if you want simple, low-cost exposure to markets, index funds or ETFs might be the best choice. If you believe in active management and don't mind paying higher fees, the mutual funds could make sense. And if you are an institution with billions to allocate, well, then hedge funds enter in the conversation. The key, my friends, is to always understand the mechanics behind the fund before you invest. Because behind every product, there is a strategy, a cost, and a risk. So if you found this breakdown useful, don't forget, subscribe, just press the button, subscribe to the channel, hit also the like button, and share this video with someone who still is confused about the difference between these funds. And of course, let me know if you have any companies, doubts, which type of fund do you think makes the most sense today? Index, mutual, hedge, whatever. Thanks for watching and see you in the next lesson. Bye bye.